In this short video, I want to look at 3 ways that investors are fooled by their own brains. Sounds a bit weird, but you'll recognize these problems when we come across them. So, the basic problem, investing actually isn't a very natural thing to do. What do I mean by that? Well, to be a good investor, you need to be, and here come some words, logical. You need to be rational. You need to be consistent. In other words, and it's been said before by greater people than me, you need to be a little bit boring. You might be thinking, well, I can do that, but actually do we? As humans, we are, in fact, often moody, emotional, unpredictable, and too easily bored, too easily lulled into doing things we shouldn't do. So a lot of investing is about sort of combating this stuff to become more like that. All right, so rock stars beware, investing probably isn't for you. This is where you need to be. Now, you might be thinking, well, how does that manifest? I want to show you 3 ways that can manifest. 3 ways the kind of illogical, emotional, inconsistent, too easily bored side of our brains can take over and lead us to do things which we really shouldn't. So, what are they? 3 of them here. We tend to anchor to totally irrelevant pieces of information, and I'll prove that in just a moment. We're too easily swayed by what other people are doing. That's the emotional side of us coming out, or the need to make a quick buck side coming out. Follow other people, do what they're doing. And we're often too confident in our own abilities. We get a little bit smug, and that can have consequences. So, number 1, anchoring. Here are some examples. I will only sell once the price of this particular stock gets back to what I paid. All right? And people cling on to the past. They say, I'm not going to sell until I at least break even. Now, people don't like selling at a loss, but sometimes it requires a bit of discipline to do exactly that so you can move on to more profitable opportunities. But we do sometimes have this notion that what we paid is somehow relevant now, whereas the facts have probably changed, and so should your opinion. The FTSE's dropped sharply, so I sold my stocks. So you've anchored to something happening to the market that you're defining as the FTSE 100, and you've taken that on to a portfolio that may be completely different in terms of the blend of stocks and the weighting applied. But people do it all the time. They watch an index which isn't really relevant to their portfolio, do something, and they react accordingly. That's anchoring again, especially when the press hit you with FTSE 100 headlines and you feel obliged almost to react to them. The stock is well off recent highs, so I'll buy. Well, clearly it's cheaper than it was, but what are your actual criteria for buying? Just that it's cheaper? We need to be a bit more scientific than that. So you get my point. 3 examples will do. We have a habit of anchoring to the price we paid, what the FTSE's doing because everyone's talking about it, or a recent high that may bear no resemblance to the underlying fundamental reasons for holding the stock. So, what are we going to do about it? We need to stop. Set investment criteria. This is the boring, consistent bit coming in. Set investment criteria. Know why you're buying a stock. Review them on a regular, consistent basis. All right? And don't become a news addict. Turn off the TV. Don't allow yourself to be bombarded by internet bulletins and so on. In other words, stick to a set of investment criteria, have a plan, and don't deviate too far from it. Okay. That's anchoring. A lot more I could say. There's been entire books written on it. That'll do for now. Number 2, crowd following. It's tempting. A few people start to buy a stock. Then a few more people start to buy a stock. And you think, I've got to join that bandwagon. I've got to get on there now. Go with the crowd. The stock price has probably already risen when you hop on the bandwagon somewhere around here, just before everyone bails out and it heads south. All right? We've all done it. Following people in and following people out. The madness of crowds, it's been called. The result, we tend to be greedy and fearful at the same time as everyone else, when in fact, many, many great investing brains, such as Warren Buffett, have said you want to be greedy when everyone else is fearful, and vice versa. And there's a consequence to this. Being greedy with everyone else means you tend to buy high, you buy when stocks are already popular, you tend to sell low, i.e. when everyone else has bailed out, and on top of that, you quite often trade more often than you should because you're copying other people who are doing exactly that. And just to give you an example, this idea, people concentrate on, did I choose the right time to buy a stock? But what about, did you choose the right time to sell a stock? There's an example. JP Morgan, in a recent report, have calculated that by selling at the wrong time, dumping stocks just before they actually recover, if you miss the best 10 investing days between 1993 and 2013 down the bottom, you can halve your annualized returns from the S&P 500. Why? Because missing those 10 good days means you miss all the subsequent compounding of the returns you would have made. So it's pretty expensive. Okay, it's a message I've mentioned before, but it's well worth reinforcing. What are we going to do to stop? Don't panic sell. Do not follow everyone else out of stocks just because everyone else is piling out of stocks. Know your criteria, know why you're selling. Don't chase the latest hot stocks on the way up either. Okay, so it's pretty obvious stuff, but it's easier to say than to actually do. And trade systematically. Have a plan, all right, know how you want your portfolio to be structured and stick to it. Thirdly, and finally, overconfidence. Now, this ripples through all parts of our lives. We all think we are better than average drivers. We do, but clearly not all of us can be. We think, especially after a drink, we're better than average conversationalists at a party, and we all think we're better than average investors. We'll beat the crowd, we'll do better than average. But don't be so sure. You need a system that distinguishes luck from judgment. And all too often, people who get a bit lucky to start with in investing begin to think that they're exercising this when in fact they're relying on that. What can you do about it? Well, keep a record of why you bought a stock. Know why you bought, and therefore subsequently you'll have more of an idea as to whether you've performed well or not through luck or judgment. You'll be able to look back and say, well, did I expect what happened next or not? If you did, a bit of judgment. If you didn't, perhaps a bit of luck, especially if the stock rises. Review both profits and losses. People often focus on losses, very anxious, and why did I make a loss? And they spend hours and hours, but they focus less on profits. If you made double the profits you were expecting, don't just go hooray and spend it all. Analyse why that happened. How much of it was down to your skill and how much of it was a little bit of a lucky run. No harm in having a lucky run, but at least recognise it for what it is. And monitor your allocation between different stocks. In other words, don't take a diversified portfolio, let a couple of winners run to the point where you've almost got just a couple of winners and a load of other stuff in the portfolio. I'm not saying don't run with your winners, but I'm just saying be careful. You don't effectively create a kind of single stock portfolio by mistake or by accident. Okay, so just monitor your allocation between different stocks and make sure you're still sticking roughly to your original plan. Quite a lot of ground covered there. Any questions? editor@killick.com.